Our next guest says, buy every tech pullback. We're joined now by Scott Wren, Senior Global Equity Strategist at Wells Fargo. A lot of yelling going on tonight, Scott. I don't know what's in the water here. Yeah. But buy every dip in technology. Scott, I got to ask you, because we've seen a tough couple of days for the social media stocks. We got a time when investors are saying, you know what, they're going to have to increase spend to a degree. We don't really understand how much they're going to have to increase spend. And then we had these two companies today, Micron and KLAC, at a Citi conference talking about oversupply in the market. I mean, these are two major forces in the tech sector, and yet you're saying buy every dip.
Well, I think, right now, Melissa, if you think that the global expansion is going to continue, you have to look at sectors that are going to participate. And, what we've done, and, you look at some stats today, the tech sector index, the GICS sector index, it's up 25% almost from the February lows, and we've just coughed up 3% of that, while, the S&P's been up about 10% over that period of time. So I would argue, you look at this thing technically, you would expect some pullback. You would expect a little less momentum. And really, the tech sector index has not touched the 200-day moving average since June of 2016. That kind of time, it usually doesn't happen. It happens more frequently than that. So, I would argue, the tech sector index is down 3%. If it was down another 3% or 4% or even 5%, you might not even touch the 200-day moving average. You might be close. But technically, the tech sector still looks pretty good, as does the S&P 500 as a whole.
Hey, Scott, it's Tim. But you talked about a global expansion, and I guess this is my problem, but it leads to my question. I'm not right now. I think the global expansion is being held in question, and we continue to get these data points around the world that everyone else is slowing. So at what point do you look at PMIs and global leading indicators and say, you know what? Maybe this has changed, and where do I have to change my assessment on stocks?
Tim, that is to me the biggest two risks that we have to the S&P 500 anyway. Is the Fed going to make a mistake, which I think is a low probability, and then also is global growth going to slow down? Now, our macroeconomists think we obviously had a stumble here earlier in the year in terms of some global growth, but they're confident that we're going to see better news as we move into the end of the year. So for me, that is a risk. Some of the data has looked pretty dicey in here, but based on the research that we're doing, I think the market's a little more worried about that than what the actual result's going to be.
Scott, nobody seems to be making a big deal. Emerging market currencies get crushed, emerging markets down. David just said it, he didn't think it's systemic, and that's what makes markets. But at what point do emerging market weakness and currency that moves percentage points on a daily basis, when do they matter for U.S. equities?
Well, I tell you, I think that there's less chance of a contagion this time. But you look at a chart of any emerging market currency index, and it is totally catch the falling knife situation. It cannot get up. So I think that there's going to continue to be fears about that. We feel pretty good that we're going to see 6.5% growth out of China. I think some of this is overdone, but clearly, I think that the market is worried about contagion, although we think there's less chance of that this time around than last time.
All right. Scott, thanks for joining us. Good to see you.
All right, guys. Have a good evening.
Scott Wren, Wells Fargo Investment Institute. Buy every dip. Buy every dip.
Yeah. Buy every dip, Dan.
I think the point is, you've kind of covered this throughout the year. We have the Dixie, we have the dollar index at 95. Okay, and a lot of people didn't think it was going to be here. But if you go back and you look 18 months ago, it was at 100, right? But then if you go back 8 months ago, it was at 90, right? So here we are with this dollar that's kind of moved around. It's kind of moved higher. It's caused what we've seen, some of the trepidations in emerging markets, clearly in emerging markets debt. And that's the issue that people are kind of considering whether there's going to be contagion or not. I look around in the equity world, and I see U.S. equities are the only major indices that are up on the year. Okay, so there's this massive flight to quality. We see it in the dollar, right?
But at what point is that divergence something that's so extraordinary that, first of all, you're at a very rare event from a probability perspective, and that means either you have to have a correction or the U.S. is next to go. I don't think that the rest of the world can trade straight down. And again, European stocks, if you look at the FES, which is the ETF for the Euro Stoxx 50, that's at a 21 RSI, relative strength. And again, oversold as we've been in months. And again, we're back to these lows from almost 2016. So at some point, that concerns me, Dan. And again, I go to the data points because a lot of them are confidence infused,
Okay,
and there's zero confidence out there in the world.
Just making one quick point, though. What we saw today is mild guidance out of some semis. If we were to see this, especially when you have FANG pulling back for good reasons because of spending, you're going to see 25% of the S&P, or excuse me, of the tech sector are going to go flat. They're really going to kind of just slow down here. So what's the other things that's going to accelerate them? If you don't have global growth expanding, to me, that's where you're going to pull back in the S&P 500.